A lot of people asking, what does it take to be a consistent trader? What things you have to do, what habits you have to follow, and how they actually become consistent in trading. Oh, we've packed for you a compilation of advice, some of the best advice we heard from traders on the podcast about how to actually become consistent in trading. You'll get to see this all. It's packed into one video here. In one masterclass on consistency, I think it'll be a big topic that can make a big difference on your results. And hopefully you like it. Leave me your favorite advice below in the comment. I want to hear what you think and what you took away from it, as always. If you want to see more, make sure you also leave a comment. And let's dive right in.
But it's the same get-rich-quick type of stuff. Here's a magic system, magic strategy, and people fall in love with that because that's what they want to hear. So I get a lot of traders that want the quick fix, that are only worried about this, that disregard trading psychology and not understanding that, yes, you can have the best system in the world, but if you can't mentally execute it day in and day out, it's pointless, or execute it without error day in and day out, it's pointless. So we still see many of those common errors, and it's the same old fix, just they come in slightly different ways. I came across trading psychology and learned the importance basically by being bad. I was bad and I couldn't figure out why. And like many new traders, I blamed everyone else. I blamed my mentor, my coach, the markets, the weather, the computer, the trading platform, until I ran out of people to blame. And it was like, man, it's me. And I remember when I ran out of people to blame, I did an evaluation at the end of my year. And basically and my mentors and coaches were telling me this the whole time, but I didn't want to believe them. I was the same young, dumb trader that I'm dealing with now. But I did a comparison. I said, okay, well, they're telling me just execute the plan, do this, do that, follow your edge, and blah, blah, blah. I looked at all my trading results and what I actually did. And then I went back to all my trades and looked at the results of what I should have done if I did everything correctly. And then it popped out to me. It said, man, like, you are trading a profitable system and strategy. You have the ability to identify trades the right way. You just keep messing up every time you do it. And that was kind of the light bulb for me, where it was like, man, it is me. It kind of hit hard. Like, I am the one messing this up. I need to focus on not sabotaging myself. And if I can do that, everything else will fall into place. So it was just, it was a harsh reality check, I guess you can say, which are the best lessons. A lot of pain will bring change often. I think it's, we're very similar to children. I'm seeing a lot of similarities in coaching, trading, and raising children, where you can tell them many times, but sometimes you just have to go through it for yourself to really feel that pain. Pain and pleasure are both major motivators. Pain is a bigger motivator than pleasure. And we can give all the warnings in the world, but it's that self-discovery, right? You have to touch the hot stove to realize, like, ooh, this is hot and I shouldn't do it again. So traders have to go through it. I think in our role as coaches, I think where we're valuable is this, where myself, I had to, I was the dummy that would make a mistake, the same mistake 10 times in a row and be like, oh, I'm just going to try it for 11th time and see if it works. I think the difference is now we can tell them, like, hey, don't do this. You should focus on this. They'll still try it because they have to go through that process. But hopefully after the first time, they're like, I see what you're saying now. That's why I shouldn't do it. So I think newer traders are still going to make mistakes, but the goal is to make less mistakes or not make the same mistake multiple times. And you can save time and money that way instead of doing the same thing 11 times and then trying again for the 12th, thinking you're going to have a different result. If you're in a rush to make results, you're probably going to be in a rush to go broke. Because again, going back to trading psychology, most trading mistakes come because you're messing up, and you're messing up because you have some type of unrealistic expectation. And man, it hurts me so much. I've seen so many traders that are good, right, by anyone else's standards, but because they have this inflated goal where it's like, man, I need to make 20% a month, they start doing different stuff, right? I had a trader I work with who made like a 10% month, which I'm like, man, that's amazing. That's great month. He's like, yeah, but I want to make 20. So he started messing up his strategy that was making him 10%. And he ended up losing money because he got greedy with targets. He got, he was rolling stops back to stay in trades. He was entering trades he wasn't supposed to be in, all because that 10% wasn't enough. So I try to tell people when I say literally map it out on like an Excel spreadsheet or a graph, right? The power of compounding is amazing. And if you understand a J curve, it starts really slow and then it shoots up. And although that 10% or whatever that number is going to seem like a little bit at the beginning, if you consistently do that, at some point your profits are going to boost exponentially. But you just have to wait out that period of time before it gets there. So be happy with your profits, right? Something is always better than nothing. And, don't throw away something good for the hope of something great that probably isn't achievable. For me, I like consistency. So I don't like big dramatic swings. So like I remember the last week, here's a good example, right? Because we may be facing this again. What was it? Would have been 8 years ago now. Whenever Trump was president for the first time, we would see massive, dramatic, out of the norm swings because he was the first president that was very vocal on like social media or would say stuff that didn't go through like a PR person who wrote the speech for him. Trump kind of says what he wants, and sometimes it's factual, sometimes it's not factual, and the markets go crazy because of that. And that introduced a lot of inconsistencies because you can have a classic pattern setting up which should do a certain thing. Then all of a sudden, boom, the markets take off on like a 100 pip rally. And you're like, why? And it's like, oh, the president came out and said something, or this was that and this was that. And then it goes back to normal. And for someone that relies on a rules-based trading strategy where it's, we're consistently looking for the same things and we're playing an edge, it kind of messes things up. So, I don't like low volatility because low volatility doesn't offer opportunities. But when the market has a steady kind of normal-ish flow, whatever normal is, it makes the price action patterns very predictable, and that makes me profit. So I like volatility, but not kind of the sporadic. And I guess even recently we've had that with all the monetary policy changes where every economic, event that comes out, they're going to cut by this much, they're going to cut by that much, like we had earlier in the year. That's not great for the market as well because everyone's panicking. But I do like a kind of a smooth flow to it. I try to review if a trade is complete. I try to review right away. That way all the emotions and the ideas are kind of fresh in my head. But if that's not the case, I always do a review process at night. So usually it's either right before or right after I put my kids to bed, depending on what time they're getting home that day from whatever practices they're at. But at the end of the day, I review, I take notes of everything. I spend a little bit of, I call it sandbox time, where I just open up a random chart and just be curious, be creative, and just look for different things in the market. Kind of like, imagine it's like a workout in the market, just trying to stay fresh. But yeah, I do that review process every day, whether it's reviewing trades that were taken and writing them in the journal and taking notes, or whether it's just reviewing what the market did, meaning I saw something in the morning, I come back at night, what did the market do? Why did it respond at that level? Taking notes and just kind of, again, trying to grow as a trader from a technical perspective on a regular basis. If things can get stale, things can get boring, you can get kind of locked into a routine, which is good, but it is, like I said, doesn't allow you to grow. Something I do every year is I dedicate a certain period. We're going to have that probably in about 3 weeks, usually right after Thanksgiving here in the States. I do that is I dedicate a period to continued education. So very rarely do I get to work on myself, which is a negative, but it's the price of coaching. It's a give and a take. But from really, let's say beginning of December till about the second week of January, so like a 5-6 week period, is my period of continued education. So each year I give myself a project, right? Aside from an annual review, it's either, read a new book. It is take a training course. It is do some strategy development. So last year I read a book, right? And just something that I was unfamiliar with and something that just allowed me to kind of understand a new concept. I did that 2 years ago as well. And it was something that I actually ended up using in my trading, which was delightful. This year, it's going to be strategy development, where I'm going to try to build a strategy. I already have some ideas of what I want to test, but I'm going to spend those 5 weeks attempting to build a strategy and see if I can get something profitable. And I've done this before. And the cool thing is, sometimes I'm able to create something that is awesome. Sometimes it fails miserably, but each year I'm able to learn something because something in that process works, whether it's like, hey, the target taking method that I experimented with, that works, but everything else sucks. Or whether it's like, hey, this entry method was good, I just couldn't get the risk reward to be in my favor. And little things like that find their way into my trading at some point. So I always look at the strategy development period. Even if the bigger picture strategy doesn't work, there's probably some aspect of it that was positive, or maybe you stumble across an indicator that you've never used before that now kind of can play a role in your trading, which is pretty cool.
You've really got to want to do this. I think that's very important. You've still got to have that excitement and enjoyment out of it. you've got to approach it realistically. And obviously now there's more ways of doing well on prop firms and all that type of stuff, which is great, but you're still going to be in a position to do that properly. You can't just come into the market and go, I know nothing about trading. I'm going to spend a month researching online or doing a course or some podcasts or something, and then go, I'm going to go and open a prop firm. Because, and the issue that I see is it's almost made it seem too easy. And as you and me both know, trading's not easy. You know, it takes time and dedication, skill, etc. to do it. And I think if you come into it with your sole intention is to have to make money, it's probably not going to work for you. If you come into it with the intention of, I'm going to dedicate a bit of time into this, a bit of expense, and learn it properly, and do the basics and do the homework and seek help if that's the way you want to go, and be consistent, then it will work. A lot of people come into it a little bit sort of either gambling mentality or, don't see that they have to put some effort in. I think that becomes the issue. But look, I've got a lot of people who are doing incredibly well, and prop firms are a big help for some of them who choose to go that track. But what people don't see is they've gone and done a year or two of work and demos and small live accounts and some successes and some failures to get to that stage, like you and me both have. I'll go back to the helicopter example. Fantastic, fly around, do all these cool things, but I've been doing that for 10 years, and it's taken a lot of trial, not so much trial and error with the helicopter, but a lot of effort and dedication and learning and expense to get to that stage. People just see the end result and think it's easy, and don't see like anything good in life, it takes a bit of effort. And even if you trade like I do, maximum 30 minutes a day on charts, twice a day, you still got to know what to look for. You still got to know how to do that. You still got to put all those lots of hours into it to get to this stage. And I think that's the other thing that people fail to see. They just go, oh, he's just trading 30 minutes a day and must be easy. I can do that. Well, it is over time, but you've got to develop that skill to be able to get to that stage. I think people are just naturally short attention span a lot of time, unfortunately. And it's, you're right. It's like, well, if something's worked, wouldn't you want to actually go and learn that? Why do you want to reinvent the wheel when the wheel is working perfectly fine? And the other thing is, I suppose, when people get into trading, is that they see all these lovely flashy indicators that the brokers will put on their charts. And they think that if we add this indicator and I create this combination of settings that no one else has ever thought about, then it's going to improve this system even more. And that's a very easy trap to fall into. And a lot of people get into back testing, and as we know, I've never found back testing to be true in real trading. You can have the most amazing back tested system, and this crosses over that and does all these things. Take it live and it fails. And I think that whole over-optimization, and people just get caught up in a big trap. And reality is that on a chart is that the price is going to move up, down, or stay sideways. That's all it can do. And so that's why I went back to looking at the price, and why does the price bounce at this level? Oh, it's hit a level, it's hit a round number, or it hit that level back here. And guess what it did back there? It dropped. So guess what it's going to probably do now if we get the candle pattern is drop. And so going back to those basics of looking at the right-hand side of the chart, how many people do we both know that come to us with trading ideas and they never look at the price? One of the things I look at, especially now as people are moving into prop firms, and I say to people, what's the number one rule about passing a prop firm? And they go, oh, I've got to get to 10%. And it's like, no, that's not the number one rule. The number one rule is don't get stopped out. Don't hit the drawdown level, because that's the way you're going to fail that prop firm. So having something that isn't stupidly risky, that does allow a few losing trades, but when you have profitable trades, you do well. That that to me is the most important thing, because after all, a prop firm's not your money, it's not your capital. So what they're looking for is someone to preserve their capital. Sure, they want you to hit your profit targets, but first of all, you got to not lose their money. And I think that's where people who are new, all they see is I can make X amount of money, or my system makes 100% in a month. But they fail to look at what the drawdown was, or even emotionally what that drawdown is going to do. Like if you've got $100,000 live account and it's your money and you're suddenly 50% down, well, you're hurting. But not only that, is you now need to make 100% gain just to get back to break even. And a lot of people don't understand the maths behind drawdowns. Likewise, if you have a consistent system that does well, but just steadily does well, compounding, as another rule of maths that we both know, can be massively in your favor if you have a good system. So you don't need to make ridiculous gains and risk ridiculous amounts to do well. You just need to be controlled and almost boring approach by it, because that will ultimately win. The tortoise and the hare story, slow and steady will win.
So I was able to be profitable fairly early on, but I do state every time I talk about it, I almost don't like talking about it anymore because I feel like it sets an unrealistic expectation. But I do say that from early on, I was quick with risk. And the reason why I say that is since I was journaling early on and I was seeing mistakes, I was able to see these mistakes quicker. It's all really just all about implementation, right? So how quickly people get things and improve the market is really how quick you are able to implement correction on your mistakes. So some people take years for those corrections. Some people, it happens 2 to 4 times and they're like, this isn't working for me. And they make a quick change, and it's luckily something that was a beneficial habit and really improves their trading. I would do also say that sometimes in the beginning, doing well is a little bit out of ignorance. And the reason why I say that is like the confidence that is there is unrealistic, and it actually will help you in the beginning because you don't know better that mistake in time can actually become a bad habit. So a lot of people will have some type of beginner's luck in terms of like you got lucky a few times, but it's also hard for you to implement what you've done repeatedly in the beginning because you don't know what you did to get that win, right? So that's why journaling is something that did help me, I think, get past a lot of that quicker because I could actually see what I was doing and what I needed not to be doing. So implementing those changes quicker, I think, is what helped a lot. But I do give a lot of my credit to some beginner's luck and then a little bit of ignorance. And because in time, some of those habits that worked for me in the beginning in a specific market may not work later, right? So I may have been in a luckier market at the time with really bullish market versus consolidating market. So what I did at this time may have not worked later. And as you trade different markets and different conditions, that's where you, regardless of what type of luck or lack of luck that you had in the beginning, you still have to see what you were actually doing that worked and be able to implement and repeat that process. To fully answer the question, I was able to compound an account and grow that for over a year to be able to leave my job, but I was still working for that period of time. But it wasn't like I became a millionaire doing that. I just saved my salary pretty much, and I was adding into it as well, every single paycheck, which was bi-weekly. So a part of that was that as well, but it wasn't a massive amount because I was pretty much like paycheck to paycheck. So it wasn't like this crazy amount. But if you understand the power of compounding, I was able to do that. And the biggest part of it also, the reason why I was able to grow it is because I wasn't taking withdrawals at that period of time. I continued to work. I compounded the account for the period of a year while I was learning. And then I just learned in time, I have to follow risk. I have to minimize my losses and make sure that my wins are larger than my losses. I try to look in the market where I feel like the largest players are where the biggest volume is in the market, whether it's whatever you want to call that. I don't care what people call it. I'm not here to debate what people think it is. I just know there's a lot of volume at certain prices in the market that I'm going to be attracted to, and I'm going to try to trade those areas. So those are the areas where the liquidity is going to be right. So I'm just going to be interested in where that volume is, and then I'm going to focus on those areas. So there's different ways I recognize it. There's obviously simple old school supply and demand, and then support and resistance, very simple things. I think sometimes when people see the ways that I trade, they're quite surprised about how simple it is. But in my experience, I see people make things really complicated. And then that's why I'm talking about we have to take things away. Sometimes you have to go back and re-simplify things. It's not necessarily that I think you're learning something like a simple concept, but in depth, right? So that's where the experience comes in, is that you're learning something that maybe you may have learned in the beginning, but you didn't understand it. You didn't understand how to use it, how to apply it. And in that time of the experience, you learn better how I can trade these specific tools or systems appropriately and what works best for your trading style. So I'm simply trading in line with that. And sometimes I use, like I said, supply and demand, support resistance, but a lot of times I'm looking at wicks, right? I'm looking at where buyers or sellers were absorbed into those previous trades. And so I'm looking at when like the market or that price or the area that I'm looking at, when it's ready to trade versus when it's not ready. So a lot of times highly traded volume areas will take a little while to set up because more volume is being added around those areas. And so a lot of times I'm looking for validation of getting in when that trade looks like it's ready. And that's where that experience comes in, right? In the beginning, you may be getting in late because you miss everything, you're chasing the trade, and then eventually you start to anticipate things, and then you actually start to get in early. So in that time, it's a little bit of balance of like, okay, I was getting in too early, now I'm getting in too late. Where can I get in better, more efficiently? And it's not about perfection, right? Like trying to catch the top and bottoms of every single move may not work for everybody, and it's not really something I even advise for everybody, but it's more so for me finding what validates a trade and when I need to get in and when that price looks ready for me. And because in time, I've been able to hone in on what works for me in terms of the validation of my setup, I'm able to get in trades that tend to play out more often. And not only will my trades invalidate quickly when I'm wrong, sometimes I will just not take a trade. That's what happens again with experience. In time, you see trades that are less probable, and instead of losing on those trades, you actually just don't take those trades anymore. So experience to me has been the ultimate teacher in terms of how to implement my strategy. But in time, like I've really been using a lot of the same things and just honing in onto what works best with supply and demand, with trading in volume, and looking at liquidity in the market and trading in line with those opportunities. That was my main change. I did in the beginning, and then I changed it to just follow risk, and I get whatever gains comes from me following proper risk. So that was what changed in those like few years of doing that. Was first I had a goal, and then that expectation set disappointment that didn't have to exist because I may have done well, but I didn't reach my goal. So therefore it was like, oh, well, I didn't have a good month, but it's like, but I did. So a lot of it was changing my perception around what was good for the longevity of trading. That's only good for short term, and it wasn't realistic. It just didn't work for me. And so I'm hoping that regardless, like obviously not everybody's going to trade funds, but I hope this lesson of what I'm speaking about applies to people in their own trading, is that you follow risk and you follow implementing your proper strategy, the returns will come. But if you're focusing, basically you have to focus on the cause, not the effect, right? So focus on the process, not the outcome. So a lot of times what most people need to work on, besides obviously strategy, is biases that we deal with, right? So I talk about psychology a lot because a lot of what trading is sort of against what our human nature is. So we're inclined to seek things that are enjoyable and pleasurable and then go away from things that are not enjoyable and not pleasurable, right? Losing money is very unenjoyable for a lot of people, right? So a lot of times they're going to be avoiding that. But in the process of doing that, it's typically like bad habits that are not working out well, right? So when I was studying like how to get better at trading, I was looking at biases a lot, right? So just to go over a few of the things that I looked at and kind of studied was like confirmation bias, loss aversion bias, anchoring bias, overconfidence bias, and like gambler's fallacy, right? So some of those things have to do with like Like loss aversion bias, you're basically constantly playing defense and no offense. Like if we compare it to sports, right? So it may be good for protecting your risk, but then you're not making money, you're not being profitable because you're not looking at ways to, there's a way to practice proper risk, but still implementing an offensive strategy, right? So if you're only doing this, you're trading in a place of fear and you're trading in a place of uncertainty, and you're not implementing good processes because you're only looking at lessening and like you're scared and you're trading, right? So I had to look at things like that. Anchoring bias is basically like relying on one piece of information heavily. So you have an attachment to one thing and you keep doing that. So people will tend to do that a lot in their trading. They'll have one type of habit that they have a hard time getting over, and they're anchoring it based off one piece of information or one experience that they've had, and they've now implemented that as like their baseline of their strategy, and it's not something that's actual correct information. There's also recency bias, right? That was the other one that I kind of forgot. So that's using like recent info into future decisions. And so if you want to work against that, then a lot of times like trade journaling, if you're doing that over a long period of time, you're not doing only recent information. So you're looking at previous information, a lot of data from many trades over a long period of time. It's better to take and make decisions off of all that data versus only a short period of time, because then you're kind of using a lot of recency bias. So, and then lastly, gambler's fallacy, basically like you're always assuming that the trend is decreasing and then you're always closing trades early and you're not letting them play out because you think that it's always changing. And like that's when you're basically trading like purely based off of luck and you're like the addiction of like, oh, this is going well, but it's not going to last. So it's like, you're not able to hold trades, right? So me setting all of those individually kind of helped me see like, oh, well, my brain just actually wants to do this. So what habits can I implement in my strategy that helps me not fall into those traps or those things that don't help my trading? So a lot of the feedback like that I give people has to do in relation to like what type of biases are you having in your trading and what can you do to counter that? Whatever your habits are, if they're not good habits, like journaling is important because you see what you need to do, but implementation is more important than that's only one part of it. A lot of people will journal but don't implement any change. There's no point in being aware of what you are messing up if you haven't implemented a system to change that issue, right? So knowing the problem isn't enough. And that's what I also find interesting. Like you mentioned, people DMing me, it's like half the people know what their issue is. You don't have an issue knowing what the problem is. You have an issue in correcting and knowing how to correct that issue. So that's where experience comes in. Or you learn from someone's experience to be able to implement something that what they did to counter that specifically. And with that said, they can give you that information. If you don't apply it, then that doesn't matter anyway. So a lot of it more so has to do with discipline, more so than it has to do with the knowledge, because people know almost 9 out of 10 times what they're doing wrong, but they're not implementing something to change it. To take that one step further really quickly, a lot of people are choosing comfort over discipline. So that comfort of doing what is natural or easy to you is making your results insufferable. Where if you choose discipline, even if it feels against your nature in the beginning, it's gonna yield better results in your trading if you're using discipline in a way that is helpful to your strategy.
And the other thing is, a lot of people attempt to make absolutes out of probabilities, and you can't do that. It's very, very difficult to make an absolute hard and fast rule about something when all it is probabilities, if that makes sense to you.
So you're saying like, oh, this is a 80% win rate, therefore next trade should be a winner. Is that what you're saying, or?
No, let me put it this way. I'll go back to a pattern example. Right? On triangular formation, the optimum breakout window is 65 to 80% of the pattern length. I've had traders come to me and say, so can I say that these things break out then? And I said, no, that's just the optimum time to break out for a trade. If you've got the most reliability on a triangular formation when it breaks out between 65 and 80% of the pattern length. 60 to 85% still works well. Outside of that, your probability immediately drops to 50% from about 75 outside of that window. But he was trying to make a hard and fast rule. So I have to take this at that break. No, it also depends on what price action is doing. Because you get the breakout, well, again, if it breaks out and closes back inside the formation, that's obsolete. Throw the thing away. You've lost everything. It's as long as it hasn't triggered your entry, you haven't lost anything. But that cancels the formation. Again, people try and make hard and fast guidelines and rules out of what is essentially probability of working. Traders have got to be willing to learn. They've got to be coachable. If they're not willing to learn, they're not going to make it. And that goes for any industry. Right? A good discussion with a potential student before you take them on or before you work with them gives you an insight into whether they're coachable or not. And just like a job interview, you go for a job interview in any industry. Let's say you're an apprentice. You've got to be an apprentice for a trade. If you're not coachable, you're not going to become a successful tradesman. You're not going to become a successful carpenter unless you're coachable. If you already think you know it all, or I've read this book so I know everything. When I was working for other people and I was training their groups of students, ran into a lot of people who agreed with everything you had to say as long as it agreed with what they currently thought. The moment you stepped outside their current thought window, they threw it away. And there's a lot of people like that around. You've got to sort them out. And they've got to recognise that that's them and they're wasting their time. If they're not coachable and they've got this thought window and they're not going to think outside that thought window, then they're actually wasting their time as well. They're better off trying to go and find something else. And that really applies to every industry. The other thing with this industry is you've got all these spruikers out there telling you you're going to make a fortune in 3 months, or it's 3 months down the track you're going to be making 40% a month. Well, have you ever considered the compounding effect of 20 or 40% a month? For crying out loud. 5% a month compounded is 82% a year. How many people do you know make 82 or 100% a year? I know a few, and I'm in that bracket. But it takes a lot of time, effort, and energy to get to there. The way I put it when I'm talking to people about it is, think about this. You're in an industry where when you get to the pinnacle of your skills, you're in a position to be able to make a lot more money than a specialist doctor or a high-flying lawyer. How much time, effort, and energy did they have to put into it before they even laid hands on a client, for the doctor being a patient or a lawyer being a client? You're looking at 8 years for a doctor, and before they're flying alone, it's 12 years after your residency. Your lawyers, you're looking at high-flying lawyers, they're constantly studying and taking on new stuff. They've got to have open minds and be coachable. Same thing. So you've got to look on your education in trading basically as an apprenticeship. I've learnt this, I can progress to here. I've learnt that, I can progress to there. I can progress to here, and I can see my skills improving. And something I talk to every student about is, you're doing your back testing, which is basically practicing the skills that you've learnt. You've learnt this skill today. Go back and back test it on this. Keep track of all your achievements and your failures. Just using that. Then the next time they've got something new, go back and test it on that same one. See how you've improved with what you already knew on that, and then see what this new technique has added to that. And that way they've got a visual effect of their progression as a trader. They can see the difference that they're making. It gets boring going back and testing the same pair over the same time frame, but that to me is, I found, the best way that you can actually see your progress as you're learning new things and adding those different skills to your tool bag. Go and retest the same thing, and then compare your results then to your results now, and you've actually got a visual, effective difference between the two, and that shows you your progression. We've all got to do the boring stuff before we get to the really good stuff.
So it was a great opportunity, but I would say if anyone really wants to get, into the trading world and do their own full-time trading, it might not be the best thing to go right into full-time trading when you're ready to do that, but instead find some kind of other little side thing that won't take up much of your time, where you can earn some money. And in another way too, it just feels great to get outside of just the trading world and then be doing something else and feel like you have this importance of, like, I have this thing that I want to be working on, and you kind of earn that time. You earn that time that you can spend trading, which for me too, it helped to keep me a lot more serious about the trading that I did. Then when I did go full-time and was doing everything on my own, it was a little bit, I mean, I think everyone knows this. When you work on a computer all the time and there's no one around you and no one to really talk with about this kind of stuff. But it's also been a lot of fun, actually, just meeting people over the years and being able to talk trading in person, which this is one of not that many opportunities that come along. Say it was generally 3 things that really helped and made a real big push. One, which was just absolutely crucial, being serious about making improvements on the trades that I did. And I could definitely look back on it. And I mean, I've looked back at my old videos and been like, oh man, I was off, but it wasn't too terrible, but I was still off in what I was doing. But actually making recordings, reviewing and keeping up with that and being very diligent, making a little list of like, okay, these are my top 5 flaws. I want to fix these things, fix any kind of error trades, fix any kind of laziness, and then be taking only the trades that I know that I should be, whether they work or they don't, just be taking those. And every time they pop up, whenever I visually see them happen. The other thing was going to a much shorter time frame in general and then getting lower fees. Because I worked in futures contracts and traded, products generally on the CME, getting low fees in the low comms for something like the NQ or any of the kind of currency futures, it really did help. And you can trade those this is so far back when there wasn't micros at all, which those can also be very costly if you try to trade very fast. But having to trade either minis or even some full contracts, like something like the DAX on the Eurex exchange. So getting low fees really helped, but then just trying to be correct in the moment. I have an idea of where things are generally going. I see the action that's happening, and then I take my trade. If it doesn't work out, it's something that's not going to hurt me too much overall, but just making constant repetition of these trades day in, day out, generally on the low end, maybe 10 trades in a day, on the high end, nearly 100, and then building that up over time. And then later on, when I started working in this cryptocurrency market, now in general, if I do similar trading styles, there will be over 1,000 trades in a day. And again, it's by hand and everything, but that still might be a few hours of broken apart different sessions, generally 30 minutes to at most an hour. And even I've built that up over time. Doing this, I remember back in the day, it was hard to do 15 minutes of this kind of super intensive focus and in and out trades. You're trying to do it in less than just a few seconds. 3 to 5 seconds is still like larger end. Start feeling like you have risk on in that amount of time. So you need these very fast markets. And it was things like the NQ or the DAX, or some of the currency markets that trade futures in the US session that allow you to trade very quickly. So now I don't go back to review old ones, right, but once in a great while, I'll actually pull them up and be, how was it back then? Let me look back to 5 years ago, 6, 7, 8 years ago at this day and time. What was I doing back then? And like, oh man, what a nightmare. It's almost like looking at your old childhood drawings of like, at some point you can look back and say it's cute. You got a little bit older and like, I should have been a little bit better with this. Oh boy. But even now, if I go back and look at recordings, I won't record everything that I trade like I used to. That was for learning and improvement. I generally have an idea of what I'm doing. If things start getting a little bit tricky, or I start seeing different kinds of anomalies in what I'm used to seeing, then I'll start, okay, I need to start recording what's going on here. And I know that this is going to pop up again. I want to see what really is going on here. What's the reaction to whatever I'm seeing? And see, maybe I can do something with that, but it's usually that I want to watch out for this. There's so many different little things to watch out for. So you can save yourself from, taking a hit and generally, keep away from some risk. But seeing something that really provides a brand new opportunity or a little bit of an edge, that's a little bit harder to spot and a little bit more rare. Those kinds of things come up, like I'd say, when you're new, you see it more often. You see a little something like, oh, maybe I can exploit this. Later on, when you've been there, done that, and you've seen quite a bit of stuff, you kind of look at things and say, this just looks like more risk to me. Or maybe I'll start slowly trying this out. Maybe I could make something out of it. But generally, if I do go back and review videos, it's some kind of unique things happening, and then record a whole video. If I didn't see this happen again during that time, maybe I don't have to check it out. But I'll usually try to go back and check things. I'd say on average now, a couple of times a month.
This is more than most people would actually do it. So.
Oh gosh. But I would suggest this, if you're getting started and everything, it should be like record everything you do and review everything you do. But the big trick that did help me a great deal was if you record your entire session, then go back and watch your session from beginning to end. That's just way too much to deal with. And I used to do that, and that was just too much. It's best to just record your entire session, and then what trades you did do, go back and watch every one of those trades. So maybe I'd do like a 15-minute session, and I felt like the market was super slow, and I only took 2 trades during that time. But then go back and review that. And maybe I would do something like these short sessions, 15 minutes to 30 minutes. Take a tiny break, do another session, and then after that, then review those. Then after that again, go back and do another session or 2, and then that would be like the end of day, and then kind of take notes out of that. But without a doubt, I was reviewing, taking notes at least half the time that I was actually trading. So I would have, what I would call 4 to 8 hour trading days, but definitely half of that time was fully just review and coverage of what I did, what can I improve, how can I stop making stupid mistakes.
To me, I don't believe that you can just start trading with discretion. I don't believe you can, purely because I'm not saying you can't. I'm saying that you need a lot of money to be able to do that. If you're going to trade live money, you're basically learning on the fly. Whereas it's much better to develop a system with rules, and then build discretion on top of that. So reviewing, optimizing, just putting in the reps every day, journaling, identifying things that happen frequently. And then after, in your review process, you might say, well, you know what, I was a bit too conservative with that, and let me check how that's played out in the past. And you find I'm way too conservative on that. So I know that if we hit this level, I can be a little bit more aggressive. And that to me is what I call earning discretion. I don't think you can learn discretion, and I don't think it's something you can build a trading plan off of, or it's not a wise idea to anyway, because as I say, you have to have a lot of money to do that, and it's pretty pointless. Whereas if you can add it and earn it over the years to your trade plan, to your system, then that's a far wiser way to approach it. And that's what I do every year. Every summer and every Christmas, I spend optimizing my strategies and seeing where I'm leaving money on the table, how I can increase my aggression on each trade without being overly aggressive. And I'm always just trying to tweak it. I kind of say it like, when the heating's too hot in your house and you get the people that turn the stat right off and then right up, and then it's too hot, too cold. That's not the way to use a thermostat. The way to use a thermostat is to tweak until you're comfortable. And that's really how I approach my trading performance. It's bit by bit by bit. This is a long game. I'm going to be doing this for the rest of my life probably. So I'm in no rush. I want to make certain tweaks so that I can ultimately end up with a solid equity curve, with hardly any drawdowns, maybe not as many trades, but right a lot of the time. People who go down the route of discretionary trading are trying to rush into trading. They can't be bothered to do the work to actually build a system and go and prove that it's profitable over time, and then go and build discretion on top of it. So the fear of missing out is the elephant in the room, in my opinion. If you're trading and you've got a fear of missing out and you're worried that you aren't getting involved with opportunities, address that first. Make sure you could either take a load of trades and be very active in the charts but lose money, or you can have a system that you've got confidence in and isn't going to play on your mind when you go to bed at night and generate profit over time. That to me is the goal. I always say, like, if you're in a trade that's keeping you up at night, you shouldn't be in the trade, and it's pretty much common sense. But I think when you're just a discretionary trader, you don't know what's going to happen next. So how can you possibly ever have peace of mind purely trading from discretion? And again, discretionary trading indicates that you're not journaling anything or learning from anything. So how do you develop and grow and progress? Like, I don't know. And I'm not saying that, I'm not saying that it's impossible. And I know there are some great traders that have learnt discretionary approaches over the years, and they're very professional about it. But most traders, come on, let's be serious. Most traders that mention discretion, they just want to know what the market's going to do. They just want to feel like they just can't be bothered to do the work. That's what I've witnessed anyway, working with thousands of them. I think whether you're in business or whether you're a trader or whatever it is, right? Write this down. When things are boring and monotonous, that means profit. That means sustainable profit. When things are exciting and exhilarating and very kind of emotional, that's when you're probably either making big sums that aren't sustainable, or it's just it's very volatile. Your gains and your losses are very volatile, and we all know that human beings can't handle volatility in their emotions plus or minus 10%, more than that. So you want to really keep your equity curve plus or minus 10% from your average growth. Otherwise, you are going to become excited. Now, that doesn't mean to say that you shouldn't enjoy trading, right? You should enjoy trading if you're doing it. And the way that you keep that spark there is just constantly learning how to optimize, how to build discretion, how to review and journal and see where you're leaving money on the table, and understand how in the future you can start generating more profit by slowly dialing in that discretion. And that to me, looking at the markets is enjoyable for me. And I would say if it's not enjoyable for you, you want to question whether or not trading is your thing anyway.
Yeah, so there's a big difference between being enjoyable and exciting. Like, those are two different things.
Totally.
You're totally right on that.
Yeah. I would say you don't really want to be excited by your trading. Excited? Every time I've been excited, there was a time in April the 3rd in 2020, I had my biggest trading session, and I got a bit excited then, and I had to actually stop trading the lower time frames, and I haven't actually traded them since. And that was because I recognized that I was excited and what damage that could have done to my performance, or maybe I could have given back all that money to the markets over the next couple of years. So I went just back to my swing trading strategies and my higher time frame stuff. So if you're excited, let that be a warning. Just don't get too cocky. Don't get too because it just you'll develop fantasies about your trading, and you might start shooting from the hip. There are certain people. I've got a friend who's a great trader, but he is the type of person who he will take a 50% drawdown, and he swings and swings and swings in the hope that he connects, and he connects and makes back double, triple what he's lost, and that's great. But for most people, they can't do that, and it's purely because there's been studies proven that humans can't tolerate fluctuations more or less than 10%. So, for instance, if you was, and this is in anything, by the way, it's not just money. If there was, if you had 10 friends and you lost 10% of your friend group and you fell out with someone, chances are you'd be a little bit, oh, all right, whatever. But if you lost 3 of your friends, you would start to feel a little bit emotional. Same way as if you was paid £1,000 a month and I paid you £900 instead, you might be a bit peed off, but you probably tolerate it. But if I paid you like 800, 700, you'd start to really be like, no, this is affecting me. Same goes for if I paid you more. If I paid you £100 more, you might not be too cocky. But if I paid you £400 more, you might splash the cash and drinks on me and quickly get rid of it, right? So you become a bit cocky. Same goes in your trading. When you're trading, fluctuations greater or less than 10% in your equity curve or the volatility in your account, you're going to struggle with that. So what I would say to your question is just assume, if you're starting, just assume that you can't take more or less than 10%. And then if you find out that you can, then great. But just be aware that if you lose 50% of your account, you've then got to make back 100% of your account. And that's pretty hard to do. You know, the quickest I've doubled my account in is just over 18 months. So, 19 months to double my account. And I did that. But that was the quickest I've ever done it. So just bear that in mind. Let's just say, I was just talking about this earlier today. Let's just say that you trade off of structure, which is a very popular approach. You're trading off of major highs, and you're shorting the big highs when they're retested. Let's just say that you approach it in 4 different ways. And the first way is just a limit order, right? So you just place a limit order, and as soon as price touches that level, you're short, right? And you've got your stop loss here. Maybe you place a 2-to-1 reward to risk or a 1-to-1 reward to risk, and that's your rule, right? Then you might test that and you might say, well, actually, I'm going to test levels of aggression. So that's the most aggressive. The second most aggressive would be like a 3-bar reversal. So you're waiting for the market price action to give you a signal that we've closed. We've had some indecision, and then we've put in a lower low and a lower close on the open market, and then you get in the next bar market. So that's kind of a wait at market situation. And then if you're a little bit more conservative, you could say, well, I know we've had the 3-bar reversal, but now I'm going to wait for a retest. So I'm going to wait for a double top. And that would be your third level of conservativeness. And then even further, you could say, well, even though we've had the double top, I'm going to wait for a violation of the retracement on the double top, and then another pullback, and then set a limit order. So there's all these different things that you can test, and this is the beauty of the markets. You can go and test those rules. You can say, right, okay, if we test previous structure, I wait for this, then I wait for this, and I wait for that, and I'm going to track all of the results, and I'm going to pick the one that suits my personality best. My personality meaning I get a nice amount of opportunity, so I get a lot of trades or few trades, depending on what you need. My reward to risk profile, and you can test different reward to risk profiles. So you can do all this stuff to suit your personality so that you're not out there trading something that goes against every fiber of your being, because trading's hard enough. It demands enough from a human being that isn't part of their makeup. So you definitely want to have some rules there. And I would say to add discretion to that, then you just trade it. You trade it and see what happens, and it has a profitable edge because you've tested it, and now it's just a case of, well, how could I be a little bit more aggressive? How could I get involved with more of these setups? Where am I leaving money on the table? Do I need to give my stop loss more breathing room? Do I need to tighten my do I need to extend my target? Am I coming out of the trade too soon? And all of these things can then be discretionary rules that you can then add to the system to make it more profitable. There's 2 ways you can do it, really. Most obviously, without kind of putting in years and years of discretionary building so that you can become more aggressive. I would say there's 3 ways. 1, you trade more markets with the same strategy. 2, you trade more strategies on the same market. 3, you trade lower time frames, where you're going to get potentially more opportunity. And then 4, obviously, just build the discretion, earn the discretion to become more aggressive, so that you know the breathing patterns of the market a bit better. Then you're more confident in taking more. You're more proactive on setups, if that makes sense. I mean, yourself, when you when you put many reps into the market, right? Well, you're just looking at the markets every day, doing your analysis twice a day. You're going through your pairs every single day, and after a while, I don't want to say like I know what the market's going to do, but you kind of get this. Like for instance, there's periods of time where I just know there's not going to be any trades that week, and I'm usually right because it's just a patterns that I've seen so many times over the years. And that's why I say you have to earn discretion. You can't learn it. You have to actually it's experience, right? Like you can learn to drive a car, but when you go out on the road, you don't necessarily, you learn how to drive on the road once you've passed your test, right? Same with anything. So it's the same in trading. You build discretion when you're out on the road, when you're learning. And the way that you build that is by putting lots and lots of time into your system, not making adjustments too quickly, just reviewing and making notes of where you could make adjustments, and then doing a full review and saying, right, where am I leaving money on the table? How can I become more aggressive? How often was I right? How many trades did I take? Out of those, how many did I miss? How many should I have taken? And the ones I did take, what about this entry technique or this entry technique, or what about multiple targets? And all of these things can be then added into your system to make you more aggressive, to make you more aggressive. If you want rules for discretionary trading, just start with like price points. Because here's a little example. So one of my first early discretionary implementations, if you like, was just certain price points. So I would look for a double top at certain levels, right? But if it hits certain price levels, which I'd had written down on all of my markets, I would say I don't look for a double top at that. If we test that level, I'm going to trade a 3-bar reversal instead of a double top, because if I wait for a double top, I'll miss the trade. Does that make sense? So there's certain price levels that you can pay attention to. Just draw horizontal lines on your charts and say, wow, this one's been tested, 10, 12, 15 times on the way up. It never seems to break through. Because another thing, certain price points are more powerful as resistance than they are support. And some price points are more powerful as support as they are resistance. So notice that, take note of that. And when your strategy comes to set up in that level, you don't then have to wait for all of the setup. You could just become a little bit more aggressive and go, if I wait for that at this level, I'm not going to hit the trade because it's going to go off without me. So therefore, I can adapt my rules. I review my trading. I review my trades every day, and then I do a weekly review. And my weekly review is more about journaling to make sure that I'm always making no errors. So 4 main things that I look at is mistakes due to excessive loss. So if I took more loss than I should have, I'll note down how much I lost extra as a result of not trading my plan flawlessly. The next thing I'll look at is trades that I missed that I should be in. And again, I'll note down how much I would have won or lost as a result of missing that trade. The next thing is trades that I was in that I shouldn't be in, and how much I won or lost as a result of that. And then trades that I managed incorrectly. So I review excessive loss, trades I wasn't in that I should have been in, trades that I was in that I shouldn't be in, and how I managed the trades. And really, I tally all that up and I try and keep it at 0, a flawless traded system. My goal, and I've realized this more over the years, ultimately you just want to become more aggressive and more certain in your trades and be right more than you're wrong and have less drawdowns. That's it. So that's what I'm working towards. And the way you do that is by tracking everything I just told you. It's not only the trades that you was wrong at, but trades that you've left that you could have made money on, that you could have adapted into your system. That's real discretion. That's true discretion. Real discretion isn't putting your finger in the air and just thinking what the market's going to do, because no one knows what the market's going to do. If you think you do, good luck. Every trade, every prediction I make, so I literally do a daily prediction, up or down. Simple as that. That's on my daily swing trading account. I also take screenshots of every trade that order that I placed, even if it triggered or not. I take screenshots of trades that I was involved with, and then I sometimes I'll do Loom videos of trades that are setting up that I think are going to play out but aren't part of my trade plan, so that I've got videos for ideas and discretion. So it's constant work. Like it is. I know people think trading is, once you've cracked it, you've cracked it. You never crack it. Like you never ever get to a position where it's like, oh, I completed it. It's constant. Like really is constant. Just reviewing your trades, as I say, go through your trades, review them, make sure that you're connected to the past performance so that you've got confidence in how your system performs and what you should be doing in order to maintain that average performance in the future. If you take a big win, well, look back at your past performance. Have you taken a win like that before? If not, well, make sure that you carry on trading how you should be, because a big loss could be coming, right? And you need to average out the performance. So yeah, just staying connected to your system, journaling, reviewing, making sure you're constantly looking at past performance to stay grounded on what happens, what is likely to happen, because it's the same for losing streaks. If you've lost 7 trades in a row, that can be really tough. But then if you look back at last year and you took 10 losing trades in a row, and the year before that you look 10 losing trades in a row, well, then you're still not even at your maximum, and it keeps you a little bit calm knowing that. It's not easy, but then trading isn't easy. You want to pick something that moves. If you're just coming into trading, you basically want to get some data that tells you, you want to pick a strategy and you want to go and test it on a market to one, show you the performance of that strategy, but 2, build your own kind of identification recognition for the setup and play around in the charts, right? So for that, you want a lot of opportunities, and for that, you want movement in the market. So if you just picking first of all, I'd start off saying you want to go for one of the major pairs, right? So pound dollar, euro dollar, Aussie dollar, pound yen, something that's kind of moving a lot, and then you want to pick a time zone where it moves. So if you was to go for some exotic pair, like I don't know, some unheard of, maybe the rand or something, and you go into the Asia session, the chances are it's just going to be dead. It's going to be flat. No one's trading that market, so you're not going to see the setups. So you're not going to get the practice. So you're not going to get inspired by the opportunities. So first of all, just pick a major pair, and then go and pick a time frame that will give you some movement, and then start there and start in a session, either the London session or the New York session, not the Asia session. I've got a lot of people come to me lately asking about trading, and the most common one is like starting undercapitalized. Like everyone wants to start with $100 account or whatever, and the truth is, like, if $100 is all you've got in your trading account, go and make some more money. Like, go and figure out how to make more money, because even if you get really successful in your trading, and for some reason you're able to generate huge returns on that $100, right? Because you haven't managed vast sums of money, you're not even going to be a good trader when you get investment, because you've only got $100. You've only ever had $100. You don't have the mindset to manage large sums of money. So the first, it's an elephant in the room type scenario, because they're like, well, if I have 100, I could focus on getting good returns, and then I could go and get investment. You're missing the point. If you've only got $100 to your name, you've never ever appreciated growing capital, or you've never had vast sums of money to manage. Therefore, you're not going to be able to manage them for anyone. So that to me is a big thing. I think it's a big common approach, and I think it doesn't work. So go and see how you can get more money first, and then come back to it. No, people won't like that answer, but it's true.
So how do you like it? Again, comment below with your favorite advice on this. I want to hear what you think. I want to be able to make sure that the comment sections are a place where people can learn a lot and support each other. So make sure you leave some thoughts in the comments. And I'll catch you back here in the next video pretty soon.